All right, today we are jumping into the mind of a legend, John Bogle, and his investing philosophy. It's it's just so brilliantly simple, but it completely changed the game for millions of people trying to build wealth. And it all boils down to some basic, undeniable math. So, let's get into it.
Kind of weird question, right? I mean, we're always taught that winning is all about outsmarting the next person, picking the perfect stock, getting in at the right time, getting out at the right time. But Bogle's whole idea is built on this wild thought. What if that frantic game of buying and selling is actually rigged for you to lose?
To really get why, you first have to see that there are two markets operating at the exact same time. And honestly, this is the fundamental conflict that trips up so many investors.
Okay, so this slide breaks it down perfectly. On one side, you have what Bogle calls the gleam. This is the flashy, noisy world you see on TV. The daily stock prices jumping up and down, the expert predictions, the endless speculation. But on the other side, you've got the grime. This is the real economy. This is where actual wealth gets created, by real companies making real products, providing services, earning profits, and paying dividends to their owners. So here's the absolute key. While all that speculative gleam is flying up and down day to day, over the long haul, it just cancels itself out. The real sustainable long-term money you make from investing, it comes directly from the grime, from the actual growth and earnings of businesses. That's it. That's the only game that truly matters. So, if the real economy is what drives returns, why do so many of us end up with so much less than the market seems to be making? Well, it's time to meet the hidden villain of this whole story.
I mean, this is the question, isn't it? It drives people crazy. You see the headlines, the market's hitting a new high, but then you look at your own investment statement and the numbers, they just don't match up. It feels like there's a leak in the bucket somewhere. Well, Bogle tells us exactly where that leak is. You can't argue with this. It's just simple math. The total return the stock market generates, that's the gross return. But you, the investor, you don't actually get to keep all of that. Your final net return, what lands in your pocket, is whatever is left over after you subtract all the costs of just being in the game. And wow, this chart just lays it all out. Think of the investment industry like a giant casino. The house, the croupier, always takes its cut. So let's say the market generates a 7% return. If you're paying 2.5% in costs, fees, expenses, you name it, you're losing more than a third of your potential earnings right off the top. Gone. Just let that number sink in for a second. 40%. That small 2.5% fee doesn't just chip away at your returns for 1 year. No, it compounds against you year after year after year. Over a lifetime of investing, it can vaporize nearly 40% of the nest egg you could have had. It's absolutely devastating. That's the power of the croupier's cut. Okay, so why on earth do we keep paying these crazy high costs? Because we're sold a story, a myth. It's the myth that we can find that one superstar manager, that one stock-picking genius who can beat the market and make all those fees worth it. Let's just blow that myth up right now. This is probably Bogle's most famous quote, and man, does it nail his whole philosophy. This endless, expensive, and let's be honest, usually pointless search for that one magic stock or that one rock star fund manager, the needle, it's a loser's game. The winning move? Just buy the whole haystack. And here's why looking for that needle is such a trap. It's something called survivor bias. We look at a list of today's top performing funds and we think, easy, I'll just pick one of those. But what we don't see are the hundreds, maybe thousands of funds that did terribly and were just quietly shut down or merged into another fund to hide the bad performance. The data is clear. Yesterday's winners are almost always today's average performers, or they're just gone. So if trying to find the needle is a trap, and we know that high costs are a guaranteed way to destroy our wealth, what's the solution? What's the logical answer here? Well, this brings us to the hero of our story. And there it is. The simple, common sense, powerful tool that solves this whole problem. An index fund is just a fund that doesn't even try to pick winners. All it does is buy and hold all the stocks in a particular market index, like the S&P 500. Its only goal is to match the market's performance, not to beat it. It's that simple. And the benefits are just huge. I mean, first, by buying the whole haystack, you completely eliminate the risk that your chosen superstar manager suddenly starts making bad bets. Second, you eliminate the risk of any one company going bankrupt and wrecking your portfolio. Third, because the fund isn't constantly trading, your costs and taxes are kept super low. And finally, the most important part, you are guaranteed to capture your fair share of the growth of the entire real economy.
This is basically what it looks like. When you own the whole haystack with a total market index fund, you get a slice of every single part of the economy. You own a piece of the big tech companies, the healthcare innovators, the banks, the companies making the stuff you buy every day. It's the ultimate diversification.
Okay, so how do we actually put all this into practice? You'll be surprised how simple it is. Here's the winning strategy laid out. Here we go. 4 simple rules. First, become obsessed with minimizing costs. Make it your #1 priority. Second, forget about trying to time the market. It's a fool's errand. The secret is time in the market, not timing the market. Third, own the entire haystack with a broad, low-cost index fund. And finally, and this one might be the hardest part, stay the course. Ignore the scary headlines, ignore the market noise, and just let the power of the real economy do the heavy lifting for you. This quote from Bogle it sums up everything perfectly. Think about it. The entire active fund management industry, with all their high-paid analysts and complex strategies, when you add them all up, they collectively own the entire market anyway. They just do it in a way that is incredibly expensive, which guarantees that as a group, they have to underperform a simple index fund. By how much? By the exact amount of their fees. It's just that relentless, humble arithmetic again. And that really brings us to the final thought here. Bogle's work forces us to ask ourselves this one fundamental question. If you're paying high fees, trying to jump in and out of the market, and chasing last year's hot fund, you're not really investing. You're gambling. You're playing in that gleam market, and the odds are stacked against you. But if you own the whole haystack at the lowest possible cost for the long term, then you're truly investing. You're an owner of business itself. So what do you think? Does hearing it broken down like this, with just simple arithmetic, change how you view investing? Let us know your thoughts down in the comments. And hey, if you found this useful, do us a favor and hit that like button, subscribe, and maybe share it with someone who needs to hear this message. Thanks for tuning in.